Hello, everyone, and welcome to the Texas Mortgage Bankers Association's Education Webinar Series, a part of the Education and Endowment Committee led this year by co-chairs Hannah Barton and Stephen Bertrand. I'm Stephen Bertrand, and I'll be facilitating today's webinar titled Homeownership Assistance Programs Supporting First-Time Homebuyers. We'd love to hear from you. Please feel free to ask questions using the chat window when we begin the question and answer session near the end of the webinar. I'd like to introduce today's moderator, John Hudson. John is a 26-year veteran in the mortgage industry and a fierce advocate for down payment assistance programs in today's economy, because not everyone can borrow from the bank of mom and dad. John very recently co-founded a new mortgage company, H&M Mortgage Group, because he felt his calling was to get back to educating consumers and housing industry participants on why homeownership is a noble cause and how to get there. From 2015 to last month, John was the executive VP for Mortgage Financial Services, where he ran the wholesale division. This is where he led the charge to make MFS TPO the only wholesaler in the country to bring TSAHC, TDHCA, and SETH to the mortgage brokerage industry. Having served in various roles with the Mortgage Bankers Association and the National Association of Mortgage Brokers, this self-proclaimed mortgage geek will tell you that one of his career highlights was testifying before Congress on Dodd-Frank and being one of the smartest people in that room. John lives in San Antonio with his beautiful wife and daughter, with 3 dogs and a cat, and must run a half marathon every weekend to meditate on how to better impact housing finance. Okay, let's get started. John Hudson, the presentation is all yours.
Hey, Stephen, thank you so much for that and those kind words. And yeah, gosh, I got to update my bio now because man, now we've got a 12-week-old puppy in the house. So now we've got 4 dogs and a cat and a wife and daughter. So yes, things are completely nuts around around my life right now. But that's good, right? Because I need that energy to keep me going. So thank you everyone for being here today. I think we've got a really, really great topic to go out there and share. And I really hope that y'all take away some good nuggets that will, 2 things. A, definitely help put more families into homes, but then also B, to even help your business grow. I know it sounds kind of funny, and sometimes down payment assistance can be kind of a quote unquote dirty word in the mortgage world because there's limited amounts of revenue attached to them. But we got to look at it as if, we really are in here for the long game. And if we could do a family right and treat them with dignity and respect and give them a great opportunity to go out there and build wealth, then guess what? Our originators that do those loans are going to get their friends and their families and everybody else. And then we get more loans and then everybody's happy, right? So don't be discouraged from doing down payment assistance loans. So we've got a great panel. I've got 2 amazing speakers here with me today, and I'm going to go ahead and introduce them right now. So first, I've got Sarah Elinor, who is the Senior Manager for Homeownership Programs over at TSHAC, Texas State Affordable Housing Corporation. Yes, I know that the acronym doesn't roll out off the tongue the way it's spelled, but it sounds better, and we're in Texas, so that's just how we work. So before joining TSHAC nearly 12 years ago, she was actually employed as a housing financial counselor with nonprofits in North Carolina, Iowa, Texas, and helping families to buy homes and achieve their other financial goals. So, helping families has been very, very near and dear to Sarah for a really long time. And I believe that her prior experience really helps her understand the benefits of homeownership, right? Because that's what we've got to go out there and do is tell stories. Sarah, quick question. Say hi, and then quick question for you. Let me ask you this. So when I first got in the business, I barely knew that there was a T in mortgage. So let me ask you, what is something that you wish you knew prior to getting into the housing industry?
Sure. Well, hello, everybody. It's great to be here and excited to talk to you today about what we've got to offer. But yeah, I mean, honestly, before I got into the industry, before I started working with folks, I didn't realize that you didn't have to save up 20% as a down payment to get into a house. In fact, my husband and I, started saving as soon as we got married, and that's kind of when I entered the workforce. And we saved and saved and saved, and not until I became a housing counselor and started helping other people work toward buying a home did I realize, oh, you don't have to have 20% down. Okay, this makes it maybe not as intimidating, not as scary of a process. And so that's the biggest thing that I learned when I joined this world.
Man, I love it. Sarah, I blame Dave Ramsey for that. For people that and I hate it because, right? I mean, if people could responsibly manage a payment, then by trying to save up for 20% to put down, they're only further delaying the opportunity to build wealth. I mean, that's just it's a reality, right? I mean, a $300,000 house, holy cow! If people are trying to save up 60 grand to put down to buy a house, it's going to take them a really, really long time. And with inflation and everything else, I mean, shoot, it's hard to save money today. So, but anyway, thank you for that. Mm-hmm. And then for our other speaker, I've got John Grafflin here. He's the COO of Genway Home Mortgage. And John's been in the business for over 25 years, doing pretty much everything, right? Capital markets, operations, leading originators, so sales. I mean, he covers all facets. And John, he earned his CMB and his AMP, both from the Mortgage Bankers Association, and served twice as directors of the Texas Mortgage Bankers Association. So John is coming to us live from Dallas, Texas today. And John, let me ask you this. Okay, so you've been doing this for 25 years. I mean, you've been around the block once or twice, mortgage-wise,
or 4 or 5. Hey, yeah,
but it's not the years. It's not the years. It's the mileage. Then again, we're in mortgage, so that can.
That's a tough comparison.
Maybe I shouldn't use that analogy.
Right.
But John, let me ask you this. So I mean, but I'm sure you were probably like me, right? When I've gotten the business, I didn't know squat about mortgages until I finally, went to my first closing and saw, wow, there was something really powerful here. What is something that you wish that you knew coming into the mortgage business?
I think, I studied, thank you, John. It's great being with you, Sarah. It's nice being here today. So thanks for the opportunity. I think we go through school, and I took a lot of, economics and finance classes in college. And I think what they don't teach you, a lot of things that are reality based, they don't teach you in school. But the thing probably that if I was being taught like the power of finance, being in the United States, we have one of the most powerful tools at our disposal in all income segments. Everybody has it. It is the most powerful inflation hedge tool in the world. Is a 30-year fixed rate mortgage. People don't understand. You can buy that house at $200,000, for your example, John. Hold that home for 30 years, and Texas has been kind of a cost of living inflation market until COVID hit. It kind of has exploded. Just then also people moving in, the popularity of the state for a variety of reasons. I mean, I've got people who work for me who bought their home 15 years ago, and now it's quadrupled in value, and they've kept their mortgage, they've refinanced their mortgage, and maybe they've reduced the term. But I mean, that original mortgage, it has cemented their wealth for their retirement and to pass on, money to their heirs and their heirs' heirs. So it's an extremely powerful financial planning tool. And given how we've dealt with inflation in the last few years, it's amazing. Even if you hear terms like realtors say, marry the house, date the rate. It just, what they're telling you is get it while you can, lock it in, and at least you're impervious to what happens in the future. But the future is better. You can take advantage of that too. It's a very powerful financial lever we have at our disposal. I think it's only available to us in America, so we should be thankful for that.
Yeah, no, that is so true. And you know what? To that point, I blame the Kardashians. Not everybody is ready to live like them, and it's where the education piece goes. We've got to be doing a better story of educating people earlier on in their life that, hey, you know what? Just starting out with a starter home is the way to go and build wealth. Look, I've got a couple slides I'm going to share with the group. And then we're going to jump in with some questions here, but I think these are some really.
Oh, you accidentally muted yourself, John.
Oops! Thank you for that, Sarah. So these are some slides from the TSHAC CE course that I teach for realtors. Which, by the way, please hit up Sarah because TSHAC has classes all over the state, and it's a great opportunity for your originators, your salespeople to leverage T-Shack to go out there and well, A, educate, right? But B, also, build relationships with real estate professionals and then get them thinking ahead. But John, to your point about home ownership being the greatest inflation hedge, I mean, check this chart out. So this is from the 2022 survey of consumer finance from the Fed, and it shows that median net worth in this country was almost $400,000 for homeowners, and it was just a hair over $10,000 for renters. I mean, this is the only chart that we should be showing people in reality. But what's crazy about the Fed's website is, they've got very dynamic charts on there, and you could drag it all the way back to say 1996. And if you do that, you can see that renters, their net worth kind of hovers right around $10,000, and homeowners only goes up and up and up and up and up. A bulk of that wealth is one thing: it's home equity. This slide here, how do I go to my next slide? Okay, this slide here, this is the pre-COVID bump. This is a very powerful chart too. This shows us that white families in this country, median household income median household net worth was roughly $188,000. It was $36,000 for Hispanic families and roughly $24,000 for Black families. Again, the number one driver of that gap is one thing: it's home ownership. It's home equity. And I don't want to get into a political discussion here, but I know that I think one of the things that we could all agree on is that one of the largest problems we have in our country is the gap between the haves and the have-nots, right? So, and we can't go back and fix the past, but we can get a clean start moving forward and building this out for future generations to bridge that gap. And this is really where these programs come into play. This chart, this is from the Federal Reserve Board. I think this is really interesting, or in my opinion, it's kind of fascinating to show for us as housing professionals, because look, this is the gap between white and Black home ownership going all the way back to the mid-90s. And you see that, okay, now think about all the government programs that have come out to try and bridge that gap. Clearly, it hasn't worked. Now, of course, again, hey, I'm from the government. I'm here to help. Hasn't done anything. And so, again, I point this out there because I just want us as housing professionals, again, to realize that we can't leave it up to the government. It's got to be up to us as housing professionals. We're the ones that are going to be responsible for bridging this gap. And that's going out there and talking about down payment assistance programs and educating consumers. From a sales standpoint, again, because I'm a sales guy at the end of the day, and so I know that we all need originations. What's missing from today's market? Move-up buyers. And why is that? Well, because the average blended rate of all outstanding mortgages in the state of Texas right now is 4.2%. So we're missing a lot of people that are out there shopping right now, which leaves us what? First-time buyers. Here's another powerful chart that shows us that the MBA's purchase index is the lowest it's been since I was a senior in high school. Again, we've got a lot of buyers that are not in the market because everyone's trying to hang on to their 3% mortgage. Shoot, I know people that are trying to not get divorced because they got a 2.875. It's just a reality. So we've got to find other ways for our salespeople to go out there and generate conversations. And this is a pretty big one. So this tells us here that according to the National Association of Realtors, that the average age of a first-time buyer is roughly 36 years old, which, in my opinion, is way too late in the game. I bought my first house when I was 23. So somebody that's waiting until they're in their mid-30s or 40s to buy a house, yeah, better late than never, but man, they're missing out on a lot. But what's not being talked about is look at the number of 34-year-olds that are coming in right now to prime first-time buyer age. So we've got a real opportunity to go out there. And then demand's not going to go anywhere. So look, this is net migration to Texas. Was 315,000 last year. Mind you, that's legal migration. So we've got the housing demand is not going anywhere. So this is why what we've got to do is, again, go out there and continue to educate. Sarah, to your point, I mean, this graph here, I mean, this says it all. Currently, 20% of America still believes they need 20% to put down to buy a house. Again, we've got to go out there, educate the masses that that's not the case. Renters, 3 times more likely to view saving for the down payment as the hardest part of buying a house. Sad. And there was a study that came out 2-3 weeks ago that showed that 44% of all middle income earners in America have either cut out altogether or severely reduced their 401k contributions. So let that hammer home. So if they're renting, they're not saving a dime. But if they own a home and they cut out their 401k, at least that payment is still something that's going towards their savings. So, and then I'll leave you guys here with this one, which is, millennials, again, these are our prime first-time buyer age. Their top 2 issues are, it should be of no surprise, it's affordability and down payment. Well, the home buying process, it really is a journey, right? And it's standing at the bottom, standing at the top of Mount Everest, and going, man, that's a long way to get there. But, I'm just a staunch believer that if I could overcome the down payment hurdle, right, then I'm looking at the top of the mountain from the halfway point, and that's a hell of a lot easier than looking at it from the bottom. So those are the kind of slides. I hope that those kind of have sunk in, right? And so with that, Sarah, I'm going to jump over to you and ask you this right out of the gate. So can you give me a good overview of what is it that T-Shack has to help, help first-time buyers? Are these programs even for first-time buyers? Are they even really for low-income people?
All right, you ready for me to run?
Go for it.
Okay. So I did bring one crazy stat that I just read the other day out of an article, which kind of, adds to your why you should know about down payment assistance. And it basically said that today's typical mortgage payment has nearly doubled since 2020. So in the last 4 years. And someone needs to earn about 80% more than they did 4 years ago to afford a typical mortgage today. So that's a huge increase in, or I would say decrease in affordability across the nation. And that's why, we really are stepping up our game. We're thankful to people like John that can help us get the word out about our programs and educate folks about them, because that's our biggest hurdle, right? Is just letting people know that these programs do exist and can help them with their down payment. So the number one thing that we offer up to 5%. So a typical down payment is not 20%. It's usually going to range between 3 and 5%. We have conventional products that offer as little as 3% minimum down payment. And then we have our government loan products, which is the FHA, USDA, and VA products that have the 3.5% down required for an FHA, or the VA and USDA oftentimes have 0% down payment required. So we are offering 2, 3, 4, or 5% down payment assistance. And that's based on your loan amount. So for example, I always give like $100,000 mortgage. I wish that were a thing. But for $100,000 mortgage, if we're giving you 5% down payment assistance, we're giving you $5,000. You can use that towards your down payment and or your closing costs. And for our down payment assistance by itself, you don't have to actually be a first-time homebuyer. You can be buying your primary residence. You could have owned in the past. You could be keeping your current property as a rental and buying a primary to live in going forward, and you can still use our program. And to John's point, our income limits are not as low as some people think. In fact, I should have had that pulled up, but maybe you have it in your mind, John. I don't know where most people are coming from watching this today, but like in the Austin area, I think our income limit for DPA only. John, would you mind pulling that up?
Yeah, no, I'm way ahead. I'm way ahead of here.
Okay, awesome. But it's like 130,000, I want to say, is the income limit.
Austin's going to be more than that, because I know San Antonio is 130.
Okay, maybe that's what I'm thinking is San Antonio. That's what. So San Antonio, Dallas, Houston, and Austin are like our biggest markets, and it's significant in the 6 figures as far as the income limits go for the DPA only. Oh, here you go. So if we look at, okay, so you've got Bayer. If we want to go down to Travis, that's the Austin area.
Here, I was going to stop here in
Or we can
Dallas.
look at Dallas. Yeah, what's Dallas? So Dallas is 137,875. That's the income limit. And that's for our down payment assistance only. We are just looking at the qualifying income that a lender is using to qualify that family for the mortgage. So we are not going to be looking at non-purchasing spouse income if you're not including it to qualify. So that can be very helpful too, to help more families get in to our program. So you can see that it's not, I think there's some stigma around down payment assistance that it's only for low income. And I just don't think that $137,000 a year is low income. We're low to moderate, right? And we don't have a minimum income that you have to make to qualify. You just have to qualify for a mortgage. So you can make up to our income limit. So Travis is 157.5. So that's even higher than I was thinking. We just updated these income limits, so I don't have them memorized as much as I usually do toward the end of the year. But so yeah, you can see that a lot more people might qualify than maybe you had previously thought. The dark blue number that he has highlighted here, the 176.4, that's for families that are buying a home in a targeted area. Targeted areas are economically distressed areas of the state where they're trying to incentivize people to buy homes in that area. And so essentially, by buying a home in that area, you can make more money and still qualify to get our down payment assistance. So yes, we do have a really cool map that kind of highlights a lot of those targeted areas. You see the areas in green are the areas that are considered targeted. And that kind of leads me into my next point. So we've got the down payment assistance. That's pretty straightforward as to what that offers, right? Up to 5% of the mortgage amount. We offer it as a grant or a deferred forgivable second lien, which is basically no interest is accruing, no payments are due on that down payment assistance. And if you live there for at least 3 years, we forgive it completely. So it becomes a grant in the long run, right? So we basically are offering you those two different ways of getting the down payment assistance up to 5%. That's going to help you get into the home. Then we have our mortgage credit certificate program, which is a first-time homebuyer program. The definition of a first-time homebuyer is anyone who hasn't had ownership interest in a primary residence in the last 3 years. So no ownership interest in a primary residence in the last 3 years. That is the definition of a first-time homebuyer. The mortgage credit certificate is going to help them save 15% of the mortgage interest that they spend every year on their income tax return. So they're going to get 15% of that mortgage interest back on their income tax return through this special tax credit every single year they live in that house. So I did a quick look up this morning. I always like to kind of compare our mortgage interest rates because we do set the mortgage interest rate for our down payment assistance. And the only way you can get the MCC is by also using our down payment assistance. So I looked up what a regular FHA market rate would be today without DPA. And it looks like today it's 6.29 for an FHA mortgage, 30-year fixed FHA mortgage. If you were to use our FHA down payment assistance, the second lien, where you see today it's at 6.875 for 3% down payment assistance, and you combine our MCC with that, you're basically, by combining the MCC, getting a 15% discount on the rate in a roundabout way. So your net effective rate on this particular product, the 3% DPA, would be 5.84. So you're getting a better than market rate mortgage, and you're getting 3% down payment assistance. I just feel like that's a huge story to tell right there. That sometimes people think, oh, I'm getting down payment assistance, I'm getting a higher than market rate. Not when you tack on that MCC. And even if you do get just the down payment assistance without the MCC, you may be getting a little higher than market rate. However, you're getting into the home much quicker than if you were to just sit there and save that money over, a several year period.
Yeah, Sarah, what I just plugged into the little calculator there, right, was I used, assuming 5% assistance and a $300,000 loan. So that'd be a $300,000 loan, 5% assistance. That's $15,000 our borrower's getting. The note rate, right, was 7 5/8 today, but with the MCC, that would take the effective rate to 6.5. And the borrower got 15 grand. So that's powerful. That's really powerful. So no, I love how flexible and honestly how easy it is for people to qualify for TSHAC and down payment assistance.
And the only other tidbit I want to add about the MCC, John, and I know you can back me up on this because you're now in the mortgage originating world, but MCCs can save deals.
Oh, yes.
Because you are taking that money. So you saw in John's example that particular situation was saving the borrower almost $3,500 in that first year, right? That $3,500, you as a lender can add that to the borrower's income to help them qualify for the mortgage up front. So that's going to mean lower DTIs. That's going to mean increased purchase power. They're going to be able to maybe qualify for a little bit more of a mortgage because they're adding almost $3,400 to their annual income. So a lot of times what lenders will do is they'll take that $3,400, which they know the borrower is guaranteed to get when they file their income tax return. They'll divide that by 12, and that's what they add to their income to help them qualify for the mortgage up front. So it's powerful win-win all around.
Yeah. So in an environment, right, where $20 a month can make or break the difference in a family getting into a house. In this example here, being able to add $285 back into a monthly income for qualifying. I mean, that's powerful. That makes a difference. No, Sarah, that's great. That's awesome. John, I'm going to jump over to you for a second here because, I know TSHAC, and I know y'all work with a whole bunch of different down payment assistance programs, but let me ask you this. I mean, what are some of the key benefits that you see also with helping, low income families, first time buyers, anybody?
Yeah, there's a lot of them. So one of them you see on the graphic you just had up is, a lot of the state programs, and to be clear, if a consumer can qualify for a state-sponsored program, that's likely going to be their best option because, as Sarah mentioned, you get a rate in this environment in the 5s. Other assistance programs aren't going to touch that. So, but doing right for your consumer, you need to get them to that point as quickly as possible. But if in the event they can't qualify for some reason, one of the things shown is FICO score. There are several other programs you can get with a lower than 620 FICO score. Some go to 600, some go to 580. Some will take it if it gets an AOS approval. Some will take manual underwriting. Others will take if they need a more affordable home and it's manufactured. They're looking to get a multi-family unit to help put family into other units or to create other forms of wealth like rental or passive income. You can do that as well. And so there's not a one size fits all of these. As an originator, I feel you should strongly keep a waterfall of these programs in your toolkit to share with your borrowers and find the best fit for them to help them meet their goals. There's a lot of programs out there, and it's kind of similar to Sarah's example of top where, which thing you had save for years for a down payment to buy a home. I remember getting a call from my cousin a few years ago who served in the Army for 4 years, not realizing when he got discharged, he can get a 0% down VA mortgage, which after I picked myself off the floor, I got him in touch with a very good lender in his market to get him a VA mortgage and get him into a house. So it's just having everything you can in your tool belt, knowing what different options are there for what your borrower can qualify for.
No, that is true, right? I mean, in doing this for 25 years, I guarantee you've seen the same thing, right? No two families alike. They're like borrowers are like snowflakes. I mean, they just are. So it really is kind of custom. But so with that too, though, there are definitely some similar challenges that people have. What do you see are the most typical challenges that people have when either I mean, quite frankly, not even just when they're applying for a mortgage, but in choosing, okay, which down payment assistance is best for me. I mean, there's a lot there. What are the key challenges that you see out there?
Sarah and I probably see a lot of the same ones where I think, income. I mean, I think, and every program has different DTI or qualification requirements. I think the non-state programs are probably a little more liberal, but regardless of what program is, I mean, there's going to be DTI issues that everybody comes across. There's some people who, again, will look at, well, maybe I can get a multifamily home that has some rental income that comes with it to offset DTI. Sarah, you did a great job of mentioning the MCC program, which can help you defray some of the payment. Sometimes there's not a solution for everybody, but if you look hard enough, a lot of people there are.
Yeah. No,
yeah, and I think the biggest thing when buyers call us and they don't know where to start, I try to put them in touch with a really educated lender that is passionate about trying to get these families into houses. And we have a website dedicated to promoting loan officers that use our program a lot, because I know that they will take the time to sit down and go through, like John said, all the options that there are out there and try to find the one that best fits their needs, so that they can choose which one they want to go with, that best fits their situation.
Yeah, you know what, Sarah, that's a great segue, because what I was going to ask you next was what are the steps a family should take when they're interested and wanting to know what's out there?
I will say I have to put my housing counselor hat back on for a minute and say that getting educated, I think, is the best thing that they can do first if they don't know where to start. And just knowing that there are housing counseling organizations all across the state of Texas that are dedicated to teaching people how to buy a home. And they actually have curriculum that they follow that teaches you, and it's called Realizing the American Dream. That's the curriculum that they follow. And they will teach you about the journey to becoming a homeowner. And so completing that homebuyer education class, it's usually going to be between 4 and 8 hours, depending on if you take it online or if you take it in person. But that's where I would tell people to start, because this is the biggest financial decision of most of our lives. And so you want to be as educated as possible. And once you get that done, then you can go find a realtor and a lender. And you can find both of those. We have a list on our website, but, finding a lender is the best place to start, that an educated lender that knows about all these assistance programs, so that they can, like John Grafflin said, find the best fit for you.
Yeah.
They have all the tools.
There's a really great statistic that's in the TSHAC Overcoming the Down Payment Hurdle CE class regarding homebuyer education. And, for all the operations and servicers on the call, I believe that y'all might be very interested in hearing this. Sarah, can you tell us that number?
You're going to put me on the spot. Yes.
Okay. All right.
It's, I want to say that like over 80% of home buyers are more successful in being not defaulting on their loan if they've taken one of these classes. And I think you've seen some of the agencies kind of take that direction, right? Where like Fannie Mae, Freddie Mac, they're creating their own homebuyer education courses and giving incentives to home buyers that take those courses when using one of their loan products, because they're seeing that if they do that by giving them like an incentive financially on the loan, they're actually making more in the long run, because that borrower is going to be more successful and actually make their payments on time and, stay in the home, and they're not having to foreclose or default or anything like that. So it's really proven to everyone that homebuyer education is actually making a huge difference in the long run.
It's huge. I mean, John, what is your difference in cost of servicing a loan that's performing versus going into specialty servicing.
It's 6 times more expensive,
Right.
at least, and then you don't get all your money back when you file a claim. So these assets definitely are more high touch to service, and whoever the end servicer is on most of these programs, if the consumer doesn't make a payment, the servicer has to advance it. So there's a lot riding on making sure the consumer is successful in these transactions. There's some cases there's no skin in the game like a regular down payment, and so that does create sometimes the hazard that can exist of not making a payment. But a good servicer knows how to stay close to the consumer and make sure they're giving them all the tools they can to be successful, because it is as expensive as delinquent or default servicing can be. For foreclosures, a horrible outcome for everybody involved.
Yeah, and I mean, so really, Stephen, that might be a topic for another webinar, right? I mean, the impact of homebuyer education on the cost of servicing, and maybe that's another topic we should discuss later. Yeah, maybe we should promote home education for all loans, because going back to the financial literacy piece for buyers, I know when I turned 15, I got my first checking account, and then I'd go write checks at the grocery store for $1.67, to buy whatever. But people don't get that financial literacy, at an earlier age now. So yeah, when they finally get in that house, it is something new to them to have to budget. So anyway, I digress. So tell me some success stories, and John, coming from you on the origination side, what have you seen? Sarah, I know you from the HFA side. Tell me some success stories that y'all have seen where down payment assistance has made a difference.
Yeah, I mean, so many. I mean, I think you have people who, families who have either not known that some of these options exist. And to Sarah's point, if you look at, maybe you have a primary wage earner who could qualify, but then you need more income, and you've been able to, counsel them through, well, if you, get somebody else who can, co-sign or be a co-borrower, or, give them the idea of, and I was familiar with a scenario where somebody did get a 2-unit property, and that put them over the hump, and you educate them from the standpoint of, someday you can pass this on to your children. They've got 2 units they can rent, they can create income, and help generate wealth for life. And you educate people, because first-time homebuyers, don't know as much as somebody who's had multiple homes in their life. A lot of these programs, I'm sure that Sarah can share demographics as well. The overwhelming majority of these consumers are minorities, and then they're the first of all, their families even own a home. So it's a scary journey for them. But I mean, you completely change their view of how they're going to live their lives by getting them into that home. And for a lot of these families, I mean, the home is the linchpin of their culture, and so it's a very special thing, and to be part of that's just very gratifying.
Yeah, I mean, I'll jump in and say that between Black and Hispanic households, those are our 2 biggest users of our program. I think it's around we're like heading toward 50% of our households that we serve are Hispanic. And then, maybe like around 20% are Black. So we're predominantly serving those communities that we were just talking about at the very beginning of this webinar, that we're trying to close that gap, right? But as far as a success story, I mean, one just recently came over. It's actually in our annual report. And he was a veteran using a VA loan, 0 down, used our down payment assistance, and actually got his earnest money back. So he didn't have to put anything out of pocket down on the home to get into this house using both. So basically he used, on a VA loan, 0 down, he used our down payment assistance to cover the closing costs. And then he was even able to get his earnest money back at the closing table. So that's kind of how it worked. But that's a pretty cool story. He was served by one of our Lender Advisory Council members, and he's one of our top 20 loan officers, Jake West. And so, yeah, it's in our annual report if you want to read more. But I thought that was a cool story. just showing how that we can both educate and then help them get into the house, and they don't even realize that maybe they don't have to pay anything at all in some
Well,
instances.
what's amazing is that, I mean, if you rent something, you have to have a deposit. So
Yeah.
you can own, and literally, even negate even the equivalent of a deposit probably is the risk money deposit. So it's like even that's a wonderful story.
Yeah, and then you get that money back at the beginning, and not at the end of your rental contract.
Right.
Right. So I mean, I've got a success story. I'm going to put my sales hat on for a second, but we did this transaction last year when I was running TPO over at Mortgage Financial Services. Had a broker call me up, said, "John, what do I do? I got a family here. They have to buy a house. Landlord's not renewing their lease. They're going to be homeless. What can we do?" Okay, well, let's take a look. He goes, "Well, this borrower makes too much money." And it's like, okay, let's take a deep breath. Let's take a look. And we looked at it. And yes, you know what? The borrower was over the base income limit, but they were under the targeted area income limit.
Mm-hmm.
And so what I did was I showed them how to use T-Shack's targeted area map, how to, work with their realtor and go and identify and say, okay, we can go shopping for a loan for a house, but it's got to be in this area. And sure enough, borrower wound up finding a cute little bungalow down in South Dallas. And the success there is, I think most importantly, number one primary mission, a family got into a house, right? Mm-hmm. They're on responsibly, and now they're on their path to home ownership. But then at the same time, right, from the sales side, that originator became a hero because he made a loan happen. He got 2 realtors commission checks that they would not have happened otherwise, right? So, and that opened up the door for future referrals. So, I use that from a sales management perspective. That's a huge success story because now we've primed them up to go out there and generate more leads.
Right? What we say is DPA. DPA customers are customers for life. That's our tagline, because it's true. They're customers for life, but their family and friends are also customers for life.
Bingo.
John, that example probably could be one of the most powerful wealth creation stories too, because I'm in Dallas. Anybody who's familiar with Dallas-Fort Worth area, I mean, South Dallas is probably getting the most attention for economic development expansion. And if you're getting a home there, I mean, in 10 years, that thing could be worth, 10, 15 times what it is today. So you could actually really change somebody's life in the current generation by shopping in a target area. Now, you want to get them into a home, but there's a lot of upsides in these targeted areas because they're being targeted for, to be, you put employment opportunities there, to bring more population growth there, to add more amenities and, grocery stores, shopping. There's a lot of value you can create for somebody taking that angle. It's a really good idea.
And what I've found too, and quite frankly, is, just because it's in a targeted area, I mean, now granted, I mean, the targeted designations come from Washington, if I'm correct, right, Sarah?
Mm-hmm. Yep.
So it's from the government, so it's already a year late. and where I'm going with that is that in these areas, they're not just distressed areas. Gentrification has already taken place, to your point, John, that these areas are up and coming. I mean, the redevelopment has already taken place. I'm going to share my screen one more time, and Sarah, because I think these stats are actually pretty cool. Let's see here. Can you see my charts here?
Yeah, I see them.
Okay, so
I built those babies. I'm very familiar with them.
Okay, all right. So what I'm looking at here, Sarah, and I wanted to share this with the whole gang here because I think it's also important. I mean, yes, you talked about the demographic side, but I want to point this number out. The average credit score is a 698. So, again, there's a stigma, right, about down payment assistance loans. And let's go bust these myths, because I would love it if overall my average credit score was a 698. So these aren't just troubled loans or loans for people with bad credit, right?
No.
Yep. Yeah.
The other one here that I think is important to see is, man, you guys helped almost 1,000 families a month.
Mm-hmm.
That's huge. So, and I guess I just share that to where, if you're on this call and you've got originators out there and that are not actively selling or promoting these programs, you're missing out on a pretty good piece of pie. I mean, quite frankly. So, I mean, almost 1,000 families a month. That's big. Sarah, here was these demographics. Can you tell us what we're looking at here?
Yeah, so that was my, I was thinking of a more recent board report, but yeah, so Hispanic you see is 44%. Black is almost 12%. But our most recent report was closer to I think it was like 46% Hispanic, closer to 20% Black.
Oh, wow.
Household ethnicity, the folks using our program. But obviously, then you see here occupations, a little history with TSHAC. Our programs were originally created, our down payment assistance program was originally created to serve Texas heroes. And the legislature created that program to serve teachers, firefighters, police officers, corrections officers, EMS personnel, basically first responders and teachers. Veterans were added a few years back to this profession list. And so that program was created first. And then they looked at us and said, oh gosh, you guys are doing such great work. Let's go ahead and open it up to everybody. So we have basically anybody can qualify to use our program as long as they meet our income limits, no matter the profession. But from a marketing standpoint, from a sales standpoint, I think it's nice for lenders and realtors alike to know that the Texas legislature created these programs. We don't use any taxpayer dollars to provide them. And you can market yourself to these target professions, right? It's marketing yourself to these different niches, and basically saying, hey, the state of Texas has a program just for you, and I know how to help you get it. So it's a great marketing tool, if anything else, if nothing else, I should say.
So you keyed on something there, which is a great little segue is, how are these programs funded? Because one of the big myths that I hear out there is, oh man, they're going to run out of money. So can you tell us about that?
Our down payment assistance is funded through what they call a TBA program, which is basically where any loan originated through our down payment assistance program right now is eventually sold to our investor, which is Lakeview Bayview. And they pool all those mortgages into basically a pool of mortgage-backed securities, and they sell them on the open market and the secondary market to investors. And so everybody involved gets that we make a little bit of money on every loan that we originate. And that money that we make goes into funding more down payment assistance. So it's like a revolving door. We don't run out of money for our down payment assistance program funded through the TBA side. Now, sometimes you'll hear us come out like where you see up here where it says bond. That is funded through mortgage revenue bonds. And we have a portion of bonding authority that's allocated to us by the state of Texas. And sometimes we will use that money to offer our MCC program. So we use some of that bonding authority to offer our MCC program, which that has kind of, as you may all have known, we didn't have an MCC program for several months because we ran out of bonding authority, right? We ran out of funding. But then we were able to reopen it in April of this year because we got more bonding authority. Sometimes we will use that bonding authority to come out with an actual mortgage product with a lower than market rate with down payment assistance. So that is limited funding, right? And it's available on a first come, first serve basis. And we usually make a lot of announcements kind of leading up to that. And a lot of times it's gone within a month or so. And then we'll reopen it if we have fallout where people cancel or, don't qualify. And then we'll reopen it for a short period of time and then close it again. And that's kind of how the bond works. But we've never shut down our down payment assistance program funded through the TBA. And that is why our mortgage rates change daily with that particular program, because we follow the market just like everyone else does in the mortgage industry. So what we have available is determined by the market that day, and we will update our interest rate chart accordingly. And then, yeah, the MCC again is the same funding source, the mortgage revenue bonds. And sometimes we have funding and sometimes we don't. So yeah, I know like we would love to have more bonding authority. So we always talk to people about talking to your, like John, he talked in front of the, Congress, but like talk to your Texas state legislators. I have the hardest time saying that word. And asked, Cake, T-Shack needs more money to serve more home buyers. I mean, we're really doing a lot with that money. And we're keeping people here in the state and, keeping them working, buying homes.
That is a great plug right there, Sarah, to remind everybody to participate when TMBA has their lobby days and we go up there to Austin. So make sure you sign up for that so we can tell them get T-Shack more money. So and
we'd love to serve more
up?
people. Yeah, for sure.
Is that on the calendar there yet? No, because I think it'll be next year's legislative year. Hey, John, I want to come back to you real quick because, and put our sales hat on here for a second. How can we, as originators, do a better job of supporting home buyers and families by helping clients get access to these products? What do we have to do?
I think it's a great question. I think when I'm not trying to spin it, but I think that sometimes we get a bad rap, on the origination side of being very sales forward. And look, sales is a part of everything we do. I mean, we're here selling today, but I think we need to approach this and where you can help your consumer, your borrower, is to put on your trusted advisor or your strategic advisor hat, because you think of, when your waterfall on your website, Sarah, find the lender, find a realtor. I mean, right now, these contracts probably aren't the most popular in the real estate community. But if you are a trusted advisor and you work with one of these realtors and you can demonstrate, have credibility, you can get this transaction done, and you make a case for the consumer or the borrower you're servicing, you can win through and get the contract, you can get that house. And I think that if we did, as a community, a better job of being more of an advisor, and anybody with 800 FICO and 30% down is going to get a mortgage. Those deals close themselves. But are they very rewarding? No, because it's pretty commoditized. You're being part of something special. You're getting a lot more referrals out of doing right by people who fit these programs than you are with that other set of a person you just talked about. So be a trusted advisor, be a practitioner, be an expert, and stay current and stay topical, and you will get much more business in the long run, performing that way versus just treating it like a transaction or a commodity.
And I just want to piggyback on that. Like you were saying, the person with 30% down, great credit, it feels like most loan officers are kind of vying for that buyer, right? They're like, ooh, I want that one. I want that one. Everybody's going after that. Nobody's going after the people that need down payment assistance or need more handholding. So that pool of buyers is much larger and much less served, lower served or less served, however you say that. But so that's where I would say, if you are knowledgeable about these programs and have them in your toolkit, and are willing to seek out and serve those folks, then your pool of buyers is a lot bigger and a lot easier to serve.
Yeah. No, it really is. I mean, I've got a note on here, just about future trends, but I'm going to show this slide for a second because I believe that this is powerful too. And what we've seen here in the post-COVID quote end quote recovery is that, look, savings rates have dropped. I mean, tremendously. Any savings that people had that they saved up during COVID, it's gone. And overall, for the most part, people are living on credit cards. I mean, it is hard to save in today's economy. Inflation has kicked everybody in the rear end. And so I don't see demand for down payment assistance waning anytime in the future. And I know that myself as a professional and an originator nowadays, right? I sure as hell don't want to be a commodity. I mean, that's just the reality. So I just don't see the future demand for these products going anywhere. I mean, do you, Sarah? I mean, do you, John?
It's going to go up. It's going to go up.
Yeah, I think so. People are going to it's going to take time to get back to where people were before with their savings. And even, even once they get there, it's like, do you want to use your savings to buy the house? Like, I mean, why not keep that in your account or go put that back in your 401k and let it grow and then use our program to help you with the down.
I mean, you just nailed it, Sarah. And that's, but before we wrap up and I turn it back over to Stephen here, I will just say, this is, just another success story of what I've seen, like real live example. And it goes back to a family that had $16,000 in their savings, right?
Mm-hmm.
That was their savings. They worked very hard to save that money. Had they just bought the house and not used down payment assistance, it would have been completely depleted, right? They would have had less than $500 left over, which, we could still get them a loan. Man, that's leaving somebody in a really bad situation. So by introducing the opportunity for down payment assistance to this family, they were able to utilize T-Shack's program, buy the house, and still keep their 16 grand in savings. And what I can tell you that me as an originator, and that's awesome. I got another family into a house. Me as we're putting my mortgage banker hat on, that's a much better loan. Because when they get a flat tire, they're going to have reserves to cover that. Or if
they're
they
going
run
to
into
pay
issues,
their mortgage still.
they're still going to be able to make their mortgage payment. So
sustainability.
Yeah, it helps strengthen loan files. So with that, I'm gonna wrap it up here. Stephen, I know you wanted to open it up to some Q&A, and that we got a couple minutes left. So fire away, my friend.
Yes, thank you, John. We're excited to use Microsoft Teams for the first time with the TMBA webinars, and I thank the TMBA staff for the excellent work in getting this up and running. To send questions through, you'll want to use the Q&A bubble at the top instead of the chat window. We do have one question, and Sarah, this one is for you. The question is, how often does T-Shack review average home prices in Texas and reassess how much 5% is, and therefore raise the total dollar amount offered?
Okay, so what I will say is we update our income and purchase price limits once a year, and that is based on HUD's, all of HUD's information, right? They send it down and say, okay, here are the updated annual income and purchase price limits for all programs across the nation. And then we update ours according to those numbers. So that's once a year, right? And that comes from a national level. Our down payment assistance by itself, we don't have purchase price limits. So we basically follow whatever they're able to qualify for, whatever the loan product itself's limits are. So if they qualify for a, $400,000 mortgage and they meet our income limits, credit score criteria, then they can get 5% of that. We don't limit the amount that they receive. It's 5%, and we don't have purchase price limits on the down payment assistance by itself. Now, if you're going to combine the down payment with the MCC, we do have purchase price limits. They're based on county, so they're going to vary for the 254 counties that we have here in Texas. And I will say that that's never really been an issue because the purchase price limits are pretty darn high. And the people that are qualifying for our program income limit wise don't tend to qualify for more than our purchase price limits allow, if that makes sense. So that's usually not impeding them from using our program and being able to buy what they want to buy.
Yeah. So Sarah, just to your point there, the base maximum purchase price with the MCC across the state is $510,000. And obviously that goes up for certain areas, just to give you an idea of that, right? So Tarrant County, the maximum sales price with the mortgage credit certificate is $577,000. So it's going to be very, very far and few between that you actually hit that peak
Right.
because because of inflation, right? Insurance is high, taxes are high, the rent's too damn high, everything's too high.
Great. Thank you all for the answer. We have no further questions at this time. So I want to thank you, John Hudson, Sarah Elinor, and John Grafflin for taking the time to share your knowledge and experience with us here. Thank you all for joining today, and we hope you've learned more and enjoyed the presentation. TMBA continues to bring you great webinars like this one. Please check out our homepage at texasmba.org for the upcoming schedule. Thanks again, everyone, and that concludes our webinar.
Awesome.
Thank
Thanks,
you.
everybody.
I have one dad joke to leave
good.
everybody with. A
Go
smile.
right ahead. Sure.
Okay. So what does a house like to wear? A dress.
That's great. What a great way to end, Sarah. Thank you.
Thanks,
That's
everybody.
great.
All right. You're
I'll
welcome.
remember that. Bye, everyone.
All right. Bye, everybody.
Bye-bye.
Thanks again for the invite. Bye-bye.